Hello, everybody. Welcome back to our discussion, Chapter 2. We left off after talking about the filing status. This slide tells us the standard deductions for 2020. And these are adjusted automatically by inflation each year. So, yes, you have to look up each year, but you get an idea of the amounts, and they just go up a little bit each year. And they're always rounded off. They're not going to end up being some really odd number. So we're up to 12.4 for single, 12.2 in 2019, just to give you a feel for how much things usually change. Married filing jointly, 24.8. Separately, half of married or the same as single. So you see where there's not really advantage in that for married filing separately. Head of household in between, right? Halfway in between. Single and married filing jointly. And then qualifying widower, as we mentioned, is really just the permission to use the married filing jointly status. And you can see it's exactly the same. Now, where it gets a little bit tricky is there is an extra standard deduction on top of the numbers that we just gave you, okay, that applies if you're over 65 or blind. So of all the things that the tax law, they chose to decide you qualify for extra standard deduction, those are the two things. So if you're blind or over 65, meaning you turn 65 at the end of the year, then you get an extra standard deduction. Okay? We'll get those on the next slide. There's also a special rule if you can be claimed as a dependent by another taxpayer. So remember we went through that whole discussion about what is a dependent. If you can be claimed out of those rules, you still may have to file a tax return based on your income. But if you do, and you are claimed on somebody else's tax return as a dependent, then you are limited in your standard deduction. It's no longer the $12,400 for a single person. It is limited to $1,100 or the earned income, meaning what you got from a job or a business or something like that, plus $350 of unearned income. Up to, but never more than, the regular standard deduction for a single individual. So it can never be more than the 12.4. But no matter what your earned income is, okay? But it's $1,100 if you have no job or income that comes from work or that sort of thing. If it's all interest or dividends, things like that, then you have just $1,100. Or if you have a part-time job or something like that, then it's up to the amount you earn on the job plus the $350 on top of that. That's for dependents. Back to the special additional deduction for those that are over 65 or blind. And the thing is, remember, if a couple is married filing jointly, then they could have one of these additional standard deductions for each taxpayer for each condition. So if one spouse was over 65, they'd have additional $1,300. If that same spouse was blind, they would have another $1,300. So a total for that spouse of $2,600. If the other spouse was blind or over 65, they would also have one or two for that spouse. So the maximum you could have would be 4, right? You'd have 2 spouses that are both blind and over 65. That would be the maximum, if you will, special standard deduction. Notice those that are dependents don't count. It's not, they don't count, but their being blind or over 65 does not determine this, does not get you the extra standard deduction. Only those who are actually filing. All right? And notice that it's a different amount for married filing jointly and married filing separate. Any married statuses and different or lower than if they're single or head of household, which are both single statuses. Okay, so it's not quite equivalent. So at the end of your tax return, you're looking at your tax liability. We talked about how that is calculated using the tax tables or the tax rate tables in the back, providing your back of your book. And we'll see that credits and tax payments reduce the tax liability. Your total tax liability is how much you owe before anything you paid. And that's a little bit confusing sometimes because we think of the tax liability as just what we have to send in. But if we've already paid, our tax liability is what you have calculated you owe based on your income and all the rules applied. Then, from that, you then determine how much you've already paid, how much credit you get for the different credits, and then how much you actually have to pay or get refunded is your final liability, okay, after those credits or payments. And we have two types of tax credits. Those that you could get back as a refund, potentially, if the credit is more than what your tax liability, then you could actually get money back. Or those that are non-refundable, meaning they do you good, they will reduce your tax liability to zero, but they cannot result in you getting a refund. So they're not quite as valuable as you might say refundable tax credits, at least for those with lower incomes who might end up actually with tax liability, zero tax liability, and they're like a refund. Now, you paying in your withholding is always refundable, so that's not an issue on those two. And then you have the amount, either how much tax refund or amount due. Okay, you may have to pay it. That tax liability, you send it in with your return if that is the calculation. Remember, the tax return is to kind of reconcile, even out what we owe with what we owe, our liability is versus what we paid in from withholding and things like that. If you don't follow the rules, if you don't get your money in on time, if you don't file your tax return on time, other things like that, to encourage your compliance, there are penalties. Okay? Interest is one of those things that the IRS is going to charge on any amount that you owe. All right? If you are determined to owe money for a certain period of time or slow in paying it in, you don't pay it on April 15th, you pay it later, things like that, then you're going to be charged interest, and this is the kind of rates that you would charge. Now, they're not fun to pay, but we list them so you understand that this is not extortion. This is not terrible interest rates. Okay, this is reasonable interest rates similar to what you would pay if you were borrowing money elsewhere. So it's not, while it is to encourage compliance, it is not high enough to mean that you should panic if you messed up or something like that, especially if it was inadvertent. I often have to talk clients down from the panic for fear that their interest rates are going to be exorbitant. You see here, it's not too bad. Okay? Now, there's other penalties that can certainly be worse than the interest on not paying on time. If you fail to file a tax return on time, you can be a penalty up to 5% per month. And that starts with just one day, any fraction of it. So if it's due on April 15th and you do it, send it in on April 16th, technically that's a fraction of a month, that's 5%. Okay? And if you wait 60 days, doesn't matter how much you owe or how much is owed to you, your minimum penalty is at least $330. Okay? Or the amount of tax required on the return. Okay? that's less. So if you're owed a refund, then in your late filing, you're not going to have much of a penalty. Okay, because it's the amount of the tax required in return, okay, is going to be lesser than the $330, and then because they owe you instead of you owe them. That is different, or the failure to file tax to pay penalty is 5.5%. So notice, it's much worse to not file your taxes than to not pay. So if you file your taxes return and you send it in, and you don't send the payment with it, then you're going to have this 0.5%, okay, per month or fraction of the month on top of the interest. Remember the interest we talked about in the slide before. However, if you did both, if you ignored everything, they will offset the failure to pay tax penalty with the failure to file a tax return penalty. And so it will just only be the 5% per month. It won't be 5.5% per month. All right. Failure to pay estimated. Okay. You are expected to pay your taxes as you go along, not wait till April 15th. Most of us pay that in the form of withholding. But if there's other income than that which you get from wages and such, then, or we are under withheld, they withhold too little from our regular check, we could end up owing taxes. They do not want to wait, right, for their the money. So they want to encourage you to pay it as you go along, and if you aren't paying enough in withholdings, then you should be paying, sending checks into the IRS on a periodic basis. Quarterly is what they suggest. And you're supposed to pay at least 100% of last year's tax or 90% of this year's tax, okay, in order to avoid any penalty. Otherwise, you're taking too long to pay your sending your taxes. If it's less than $1,000 that you end up being off, then they're not going to worry about it. But anything over $1,000, they're going to see where you are compared to what you should have put in order to reach those thresholds. If your income for the prior year is over $150,000, you cannot use 90%. Okay, you have to use 100% of the prior year's tax. Okay. Or you have to use more than 100%. So you can only use 100% if it's lower than 150,000. Okay. If they feel like the reason why you missed up on your taxes is because you just didn't care. Okay. You missed your income by 25%. You had 2 jobs and you report one and not the other. Okay. That's the kind of thing that can cost you 20% of the tax due as an accuracy-related penalty. All right? And it can get worse from that. If they think that you intended to do that and commit fraud, meaning you intended to deceive and get away with it, it wasn't inadvertent, it wasn't just that you weren't paying attention, then your penalty could be up to 75%. All right? These are the kind of situations where you could end up with what we call criminal penalties. Fairly rare. Okay? People do not generally go to jail for tax problems. IRS has learned you don't collect much from people in jail. Okay? So typically they just add penalties and find ways to set up payment plans and things like that to pay those penalties. However, if you are into this category where it's such an understatement and it is intent to deceive, and if you are trying to get other people to do the same thing, all right, or then you could end up with first a 75% penalty and potentially criminal penalties where people do actually go to jail. Okay, but it takes a lot to have a criminal case from the IRS. Okay. Notice that the 20%, if you different penalty, if you claim a refund you're not entitled to or by error. Okay. All right. So that would be instead of the accuracy related penalty or the fraud penalty. So there are rules that make sure they don't just keep adding on more and more penalties to these. But you can see that if you are not careful, and again, if you're careful and you do try to follow the rules, the chances of having penalties that are going to, sink you is very rare. Being prosecuted criminally is really rare. But lighter penalties come fairly quickly if you are not being cautious and careful about making sure you're doing the things that are expected, especially filing your return on time or with an extension of the 6 months. You get an automatic extension. There's no reason to be late and to have to pay that failure to file penalty. That one is the one that should never really happen. There's always going to be issues that you make mistakes on other things, but you should be able to get in either the extension or your tax return on time so that you can avoid that penalty for sure.